Hi, folks. Adam Taggart, co-founder of Peak Prosperity, back here for another week of trying to make sense of these crazy markets. As usual, I'm joined by the good folks at New Harbor Financial. We also have a special guest expert this week. We've got Jeff Clark joining us. Jeff is the Senior Precious Metals Analyst at goldsilver.com. Jeff, thank you so much for joining us this week.
It's great to be back with you, Adam, and I miss your conference this year. I was there last year, and can't wait till we can go back to that.
Thanks. Yes. For those that don't know, we've had to postpone it because of the coronavirus. We haven't made this announcement yet, but highly likely this year's, which we were hoping to reschedule in person to October, is probably now going to be held virtually, and we'll have more details coming on that soon. But yeah, Jeff, always great to get to spend time with you there, and I hope we get to do the same this coming spring in person if the coronavirus lets people begin to socially congregate by that point in time.
Yeah, fingers crossed.
Yeah, fingers crossed. We're also joined this week, as we always are, by lead partner from New Harbor Financial, Mike Preston. Hi, Mike.
Hey, Adam. How you doing? Good to see you.
I'm doing great. I'm sorry John's not with us this week, but darn that guy, he's got to enjoy some time with his family.
Enjoying a week off this week. He's having a good time, I'm sure.
We'll soldier on without him, and he definitely deserves the time off. So
he does.
All right. So near the end of last week's video, Mike, we made the offhand commentary that gold was approaching $1,800 an ounce, a price that actually did eventually hit in the futures market, not in spot, but in the futures market. That is an 8-year high for the precious metal. I don't think gold's been at that price since like September of 2012, after spending many years getting beaten up in the interim. And so as we closed last week's video, I committed that we would make this week's video pretty much exclusively centered on gold and the precious metals. And hence we're joined by Jeff. So before I start asking Jeff to expound on all things gold and silver, I do want to just give a real quick recap of what's going on and might give you a chance to give you a sense of what you've seen or what's caught your attention in the past week. So markets have continued to confound the bears. They've continued to go up. I think, Mike, you mentioned that it's been an up 4% week already this week in the S&P. It definitely markets ended Q2 with a bang. Maybe that was because of window dressing. Maybe it's because of just continued mania in this rally. But that stands in stark contrast to the rising coronavirus cases we see. And there really seems to be a game of chicken going on here of who's going to win out, the market euphoria or these resurging coronavirus cases in a growing number of states. In fact, a number of states have already announced that they're going to have to roll back some of the lockdown easing that they had been enacting, and that is going to further crimp economic activity. So we now just started Q3. We're 2 days now into July. Those 2 days have been up days, so the market definitely wasn't looking to correct after the window dressing. It still seems to be pretty euphoric. Today's big up move came at the heels of the latest jobs report. The BLS announced that a record number of jobs added in the past month. Expectations were for around 3 million jobs. BLS is saying that 4.8 million jobs were added. Those are really big numbers. Of course, they come after horrendous numbers of job losses over the previous couple of months. What's interesting about this report, though, is it really does send a lot of mixed messages. Just one of them is the fact that according to the BLS, I can't remember the exact number, but let me put it this way. There are more people receiving unemployment checks now than the BLS are saying are unemployed. So basically, it's casting already some immediate doubt on the fact that the BLS's numbers don't match up with reality. The BLS themselves have said in issuing this report, hey, with all the dust in the air, there's a pretty wide range of margin for error here. So take these numbers with a big grain of salt. The markets seem to have taken them with salt and a big margarita instead. But we'll see what happens as a result of that. But I just want to give folks that caveat, which is, markets right now just seem to be, sitting on a trigger for anything that could send them higher. And they ran with the headlines here and have not seemed to taken the time yet to process the news in detail. Although watching the market close today, it it did fade a fair amount to the end. So maybe people are beginning to process in these numbers. The only other thing I want to mention too is that with if the jobs market is really kind of coming back strong the way that these numbers suggest, if you're one of those people who thinks that Fed liquidity is the only thing that matters in the markets, you should be a little concerned, because that basically takes some of the urgency and pressure off of the Fed to have to intervene in the markets if the job market's recovering faster than expected. So again, another sort of yellow flag there for those people that really only buy into the liquidity and Fed intervention side of the story, that may actually give the Fed reason to ease its foot off the brakes or off the gas even further. And of course, this builds on our discussions over the past couple of weeks as we've shown the graphs of Fed liquidity activity and how it really is a pretty tiny fraction of what it was back in April and early May. So the Fed already is really cut back a lot what it's putting in, and if the rosy job numbers give it additional reasons to basically begin to wind down, that could be bad news for those folks who believe it's only about liquidity. All right, so Mike, my question for you is, we're looking back, the markets have been strong, as I've been saying, but they still haven't closed the gap with that island reversal that we saw a couple weeks back in the markets. So it does seem like we're still in this zone where the market's struggling to get back to new highs, but not really quite succeeding. So it seems like there's a big game of chicken going on right now between, is it a new bull market, or is it a bear market rally that has just yet to really show its teeth? So with all of that background, as you look at what happened over the past week, is there anything else that I didn't rattle off that's caught your eye or that you're looking at?
No, not really, Adam. I think you basically encapsulated it pretty well. There's a couple island reversals that have happened in the S&P over the last few weeks. It was a multi-day one at higher levels that happened a couple weeks ago, and then just last week we saw a one-day island reversal. With the rally this weekend, it was a pretty strong rally. I mean, the market was basically up every day this week, and it's closed tomorrow for the holidays, so the week is in the books. Like you said, we're up 4%. We did close the gap on that first island reversal. But, overall, it doesn't really mean that much, I don't think. The market's really narrow. The technicals are somewhat weak. If you look at breadth, if you look at sentiment numbers, they're still off the chart, euphoric. Put-call ratios, like the 5-day put-call ratio is near all-time lows still. So everything is screaming caution here, yet the market just keeps going. It keeps drifting. And big picture, we're basically whipping around back and forth between 3,000 and 3,200 on the S&P. And over the last few weeks, we've just seen utmost capitulation in the people that we've been talking to out there and in the media that say that the Fed will never let the market go down. I've never seen such buy-in like that, one-sided buy-in. So we're extremely concerned about this market. We've had an 82% retracement off the low of March 23rd to the recent high in the S&P. It's historically a very deep retracement. NASDAQ, of course, is at all-time highs, and NASDAQ is just in a land of its own. If I could say anything bullish, I'd say maybe that the NASDAQ had a bullish engulfing week this week. It was just straight vertical, and it closed near the high. But overall, to us, we're seeing nothing but indicators of euphoria and a classic bubble. We're completely out of the stock market, flat the stock market at this time. And, expect some rough times ahead. Don't know when it's going to roll over. It's been lasting longer than anyone thinks it could, and it's testing everyone's patience, including ours. But we're continuing to watch and wait.
All right, great. And you said that you're pretty much not long the market at this point, but I do believe that New Harbor does have core portfolio positions in both gold and silver, the metals themselves, and also in mining stocks. That's correct, right?
Absolutely. We have and have had for quite a long time a core piece of exposure to metals or gold and silver mining stocks. We're big fans of the sector. We think there's still, even at these prices, pretty marked undervaluation. If you look at the gold XAU ratio, it's still at historic lows relative to the price of gold. Of course, what central banks are doing is icing on the cake. I mean, they're absolutely trapped in a corner and have to keep doing what they're doing. I think it's only going to be bullish.
Great. Okay. I want to dig more into that, but I want to now bring Jeff into the conversation here because we're going to roll up our sleeves and get deep into all things precious metal. So Jeff, putting aside the craziness that's happening kind of on a day-to-day basis in the market, there's a lot of big things going on right now that I believe, and I think you're the best person to explain, that are really driving gold and silver prices from a fundamental perspective. So I guess let's start with gold hitting $1,800 an ounce in the futures market there. You have been along this ride that I and many of the viewers have been on, since 2011, 2012, where we saw gold finally have a brief moment in the sun and then just get clobbered and basically kind of spend the better part of a decade in the basement. And now it's finally climbing back out into the light. So now that we've hit 1,800, or we're in spitting distance of it in the spot market, what do you see is happening next? What does this represent? And as you look forward, what's driving the gold prices here, and what do you think's to come?
Well, there's clearly a lot of momentum in the gold market, especially, not so much silver, but definitely in the gold market. I think that's pretty obvious to anyone who looks at the market. But at the end of Q2, you guys were mentioning Q2, so I had to write all this down because there's so much that happened that it was incredible just in terms of what the price action did. So at the end of Q2, which was just this past Tuesday, gold had its strongest quarterly performance since 2016. It was the highest quarterly close in history, believe it or not. It was the second highest monthly close ever. It's risen 3 consecutive months and 6 consecutive quarters, and it's almost near 8-year highs. So that's where gold was at the end of Q2, just a couple days ago. So the momentum has been incredible. It's back, we're, like you said, within spitting distance of all-time highs. So now some people might hear that data and think, well, gee, it sounds a little toppy or frothy to me. Is it time to get out or take some profits, in gold or something like that? The answer to that question in my mind has been, well, have all the risks that drove people into gold in the first place, have those all been resolved? So I'll just put it out there to you guys. Let's see, I wrote them all down because there's so many. So have all the monetary risks been resolved in the system? Is the Fed stopping its currency printing and driving rates lower and things like that? Well, no, they're not doing that. What about fiscally? Have the debt issues been resolved? Is deficit spending over? We're not doing any more of that. Well, no, of course we are. Are the geopolitical concerns subsided? Is that all good now? Are we all lovey-dovey with China, for example? Well, hardly. Is the US dollar at threat of still falling? Well, absolutely, it still is. What about the stock market? Does that offer good value now? As Mike said, this is clearly an overvalued market, and it has been, but it's still clearly overvalued right now. What about the issues with the virus and the economic impact? Is that all over now? That's all done and all better now, right? So we don't need to buy gold to protect against that. Well, of course we do. Is there any threat of inflation? Are interest rates on a real basis, above inflation? No, they're not. So I could go on and on, right? But the point is, all these risks that have driven a lot of investors outside of us that have owned gold for a long time into the precious metals market are still there. None of them have been resolved. None of them have played out. Some of them haven't begun to play out at all. And I think there's going to be more significant and very serious fallout economically yet, but especially monetarily. I do expect inflation, to come in the next, I don't know, 1 to 2 years. There's a lot of risks still in the system. It's systemic and it's structural. These things can't be addressed easily or quickly or efficiently. They're structural problems, and they're big problems that don't have easy answers. And so the answer to my own question is no, it is not time to get out of gold. Now, there may be a pullback. I'm actually hoping for a pullback, especially in the miners, and we can talk about what they've been doing recently. But I'm hoping for a pullback so I can actually buy some more. But in the big picture, if we have a pullback or a correction, that is, to me, nothing but a buying opportunity. So,
all right, and not putting you on the spot to make a prediction here, but ballpark, what sort of pullback would you be hoping for? Do you think is realistic? 10%, 20%, more or less?
oh, yeah, 10% would be normal. Gold has been steadily going up, and it traded sideways for the better part of 2 months, and then just popped up at the end of the month here. So, it's not like it's in some sort of runaway mode or something like that where it needs to have a 20% correction or more. So 10% would be well within what I would expect. I don't know if we'll get it. There's a lot of momentum. There's a lot of interest. I do write some reports for that are distributed to hedge fund managers, and the feedback I keep getting is that the interest is still high. They still think gold's going to $2,000. I think gold's going to $2,000 probably by the end of the year. So it's hard to say, where there's going to be one. But I think the point is to be prepared for a correction if we have one. That's the best thing I could say about that.
Okay. So as usual, so many questions popping up based on what you just said. In no particular order, that list that you just rattled off of, hey, the fundamental reasons to be positioned in the precious metals, have any of those reasons, gone away or diminished, right? While gold's been having this moment in the sun. It's a powerful list. Those are really big issues, and the answer to pretty much every one of them is no. In fact, it's gotten worse in many cases, a lot worse, since 2020 started. So the question I have is similar to the question I had after we had QE rounds 1, 2, and 3, which is, why isn't gold even higher given what's been going on?
Gold trades on an exchange around the clock and around the world. It's a tradable asset, right? So it trades on an exchange. So you have buyers and sellers that are pushing around the price. And yes, there's manipulation that we know of, but that's not the biggest factor that describes where gold may be at any given time. So, or certainly where it's headed. So I think the answer to that is that you have people that are taking profits, people that are still not in the market yet. We've seen some institutional advisors come into the sector, but we haven't seen an onslaught or a big entrance by the mainstream or anything like that. So it comes down to demand, and once that demand really starts to take off and the price starts to move, it'll draw more people in and it'll actually snowball. So gold at $1,800 an ounce or a little below that is actually for 1 little ounce of gold, it's selling for over $1,700 an ounce. So I think it's probably reasonably priced for where it's at.
Okay, well that's interesting. So the mental math that my brain does is, in theory, gold is a protection against inflation, right? The more dollars that get printed up, the more an ounce of gold should be worth, right? It's supposed to sort of be an almost sort of a monetary mirror to fiat currency, money printing. Federal Reserve has, kind of near doubled its balance sheet in the span of just a couple of months, right? And so that's sort of where my brain goes to, like, wow, like I would expect it to even pop a whole lot more.
Well, I think the answer to that is when you see some real world effects of all of that money printing, which we really haven't seen. We haven't seen really any inflation of that to speak of, right? We have some crises, but not a major crisis that's stopping the world, other than the virus. We've had no monetary crisis. So we've had some uncertainty, but, we're not at war or something like that. So I think once you see some real world effects of all of these things, that's when the price is really going to take off.
Okay. You said something I want to dig into too, because I'm not sure everybody understands this about the gold market, is that it's quite small, relative to the size of other financial asset categories, compared to the stock market, certainly compared to the bond market. And so you may have a better stat than I do, but my general recollection is that it's sort of, gold is held by about roughly 1% of all the portfolio. The average holding of gold in the average portfolio in the world is around 1% of the portfolio's value. In other words, it's a very small amount of the average portfolio. Most people don't have it. Some people have a lot, but the average is about 1%. And so the thinking is that if the interest in gold rose such that it went from 1% to 2% or 1% to 5% in people's portfolios, the value of gold could shoot the moon very quickly. Expound on it if you can, the accuracy or not of that statement. And if you can add on that as well, the gold market's not very big, but the silver market is infinitesimal compared to these other asset classes. We haven't talked about silver yet, but the gold silver ratio, which is the ratio of an ounce of gold to an ounce of silver, has been at a historic imbalance recently. I think it's currently at around 100. It got as high as almost, I think, 120 real briefly there about a month or two ago. But that's normally kind of in the 60 to 70 times range, at least over the past 10 years. And so at some point, I think that's going to correct. And so if you can first address my question about the size of these markets, but then talk about silver's potential here. Do you see silver catching up to gold to fill that gap in the ratio, or do you see gold dropping to get closer to silver?
Okay, so first on the size, the gold market is very liquid, but it is indeed very, very small. In fact, I haven't updated the stat, but Warren Buffett, however much cash he has on his balance sheet, might know that. But in the quarter before, Warren Buffett's company, Berkshire Hathaway, could take his cash and buy every single ounce of deliverable gold at the COMEX with 5% of his cash. Every single ounce.
Wow.
Now, that just shows you just how incredibly small it is. Warren Buffett is not going to do that. He's not pro gold. But my point is, that's just one company. That's how much cash they have. And they could buy literally every deliverable ounce on the COMEX with 5% of his cash. Now, it might be 10% of his cash now because of, the COMEX has really filled up with a lot of supply here recently to try to catch up. But the point is, that's just how small it is. On the silver side, it's even more ridiculous. Apple has something like, Mike, you might know, 200 billion in cash or something. I forget the exact number from their.
Not far from that, Jeff. I think it's 150 or something. Maybe it's 200, close to it.
Yeah. Okay. So, if you took the primary silver industry, the stocks, the miners, and you looked at their market cap and you added up their market cap, Apple Computer could buy every single share of every single primary silver producer with something like 12% of its cash. Every share with 12% of its cash. I mean, that's how small these industries really are. And the point of all that is that when money, when currency and cash starts flowing into these sectors, it doesn't take a lot to push around the price, gold or silver, especially silver. So that's why you'll see, even on a daily basis, the silver price will be more volatile than the gold price. It is on a short-term basis and generally on a long-term basis as well. So, and that's because it doesn't take a whole lot to push around the price. And so we expect, that's one reason I expect that silver's probably going to revisit its all-time highs and maybe even go higher at some point, especially when we get inflation. So, and then as far as the gold-silver ratio, yes, it's stretched to historic extremes. It hit 123.5, I think, something like that back in March, I think, during the sell-off. And it's at like 99 now as we speak. But the long-term average since 1975, when you could own gold again in the U.S., in January of 1975, since that time, the gold-silver ratio, they're both free trading, has averaged something like 55. And we're basically at 100. So there's a long way down for this ratio to go. Now, what I think is going to happen is that silver is going to outperform gold when the precious metals bull market really gets going. And when that happens, I'm looking at a 2 to 3x of silver over gold. In other words, silver doubles what the gold price does, or maybe even triples what it does, then that's what will bring that ratio down. Yes, the ratio can fall because the gold price is for the opposite reasons, but I think it's going to be because the silver price is outperforming gold on an ascent, not a descent. So
Okay, and can you just elaborate a little bit on the reasons why you think silver is gonna slingshot like that?
silver does not respond well historically to recessions. It tends to fall in a recession. It does not tend to respond well during stock market crashes. It's fallen in almost every single stock market crash, the big ones, like 15, 20% or more. Silver tends to fall in those. Well, we've had both those things, right? A recession, and we had a stock market crash a couple months ago. So it wasn't surprising that silver has been weak. But silver is still a monetary metal. It has a lot of industrial use. 55% goes to industry, right? But it still has a monetary use. It's been money and actual currency, believe it or not, more often than gold has throughout history. So it does have a monetary aspect. And when investors come into the sector, and investors are the big price differentiator in the silver industry. When investment leaves the silver industry, the price tends to suffer. When investors come into the silver industry, the price tends to rise. So they're the big catalyst, they're the big differentiator as to whether the price is going to go up or down. So what's going to draw investors into the silver market? I think inflation would be the obvious answer there. Its two biggest rises in history were in the 1970s when you had real runaway inflation, and then from 2009 to 2011 when you had the fear of inflation. So that tends to be the basis for a lot of silver's big moves. And I think that's going to happen again. It may be a year or two away, but actually what is happening right now, in my opinion, is actually normal. It's normal for gold to lead silver in these bull markets, in precious metals bull markets, and for silver to trail. But in every single instance in modern history, the 5 major precious metals bull markets, silver has caught up to gold and passed it in terms of a percentage return before that bull market was over. So I expect that to happen again. What's happening, now is historically normal. And if we do follow a pattern in history, silver will catch up to gold and pass it. And I think that's what's ahead for us at some point.
Great. All right, I'm going to dig into that just a little bit more, but before I do, there aren't that many pure silver mines out there. Silver is often mined as a byproduct of other types of mining, zinc, copper, et cetera. And so my question for you is there, I believe, have been mine closures because of the coronavirus. Right? Can't cram a bunch of guys down in a mine together without them all getting sick, right? Is that impacting, or do you expect it to impact the price of silver at all from a scarcity element, that there's just going to be less of it mined for a while going forward?
Yes, that's true. On the flip side, you've had less demand, right? Less jewelry demand, less manufacturing demand because you're in a recession. But yes, supply was dramatically impacted by COVID and the mine closures and the social distancing and all that sort of thing. At one point, we measured it. We looked at all the primary silver producers and then all the biggest base metal producers that produce a lot of silver as well. And at one point, I think it got up to as much as 15% of all silver supply was going to be offline for the year. So we expected a drop in silver supply coming to the market, regardless of what the use was going to be, and regardless of what demand was going to be. The only amount of new supply that was coming was going to be, in the range of 10 to 15% less than what it was last year. So that's a pretty big hit to supply, and that's, of course, as of now, if we have another shutdown and the mines close down again, that number is only going to go up. So there's going to be an issue where new supply is really cramped. And of course, the reason that's important is because most silver that is used in industry and in jewelry and as investors, what we buy, 2 out of 3 ounces really comes from new supply. only 1 out of 3 comes from existing supply where it's recycled, from scrap sources and things like that. So when you have, 2/3 of your supply that's being impacted by 15 to 20%, that's a pretty big number for any industry. And so that's going to have some impacts. And of course, if this trend continues, and that's the other thing, I could talk about this forever, but backing up before that, there's been a lot of silver supply that's come offline just by nature of the industry itself, because prices are too low. So it's crimped. Development projects. They're not exploring for it as much. Exploration budgets are lower. Some mines were even shut down. This is all before COVID. And then you throw in COVID on top of it. And so the impacts here and the trend is clearly down for silver supply. Whether COVID is resolved tomorrow or not, it's not going to matter. It's a structural thing in the silver supply market where supply is definitely going to come down. And again, I'm talking about new supply, not existing supply. But the amount of new silver ounces that are coming to market are definitely in decline. And it's a structural trend. It's not something that's going to be easily resolved. So when you have that happening, and at the same time, if we do get inflation or whatever would cause a lot of investors to flood into the silver market, so when demand goes up, so you have demand going up and supply going down, well, that's supply demand 101, and that means one thing for prices.
Okay, so just another set of fundamental reasons to throw onto the growing pile that silver and gold as well, but seems undervalued given current market conditions. All right, so I was going to dig more into, you said prices, particularly in silver, really are driven by investment capital coming into the market. And we've seen that in a number of sectors, not precious metals to date, but one of the things that sort of marked 2020 in the markets has been the reemergence of the retail hot money. And this is sort of personified by the Robin Hood traders, right, that are coming in and buying shares of all sorts of highly speculative things, right, bankrupt companies, that type of stuff. And to me, that type of investor seems a great candidate for the mining stocks when they really begin to take off. And so mining stocks, for those that aren't familiar with them, these are the companies that actually go out and find and or mine the actual precious metal ore, extract it and smelt it and send it off to the mints. And so these companies are what are called leveraged plays on the price of gold and silver. If you think of gold and silver as money, these companies are the mints. They're the ones that actually create it and get it out into the world. And so they can, in a bull market, precious metal bull market, they can give unbelievable returns. I mean, we're talking returns in the hundreds to thousands of percents in certain cases. I'm going to underscore all of this discussion by saying they are highly, highly speculative. So I'm not encouraging people to rush out and just throw their money in here. And I hope you can talk about that a little bit, Jeff, on who this is relevant for. But from what I hear you saying is, look, the fundamentals have really lined up nicely for gold and silver. That means that their long winter is over. And if gold and silver have had a long winter, I feel like the mining companies have had like a long nuclear holocaust. I mean, they have been the most hated sector for so many years running, and for good reason. They've really been widowmakers for a lot of capital out there. But everything is cyclical, and if their time is coming around again, this really could be a time to get into them still at very low prices, given where they could likely go. So let me just give that background and hand it to you to comment on this. But I guess the question is as you see the sun rising on the precious metals here, fundamentally, do you see the same for the miners? And what type of opportunity do you see there for the sector?
So I love this question because I love investing in the mining stocks. My family has owned mining claims in California, Nevada, Arizona. So it kind of runs in the blood, if you will. My dad even won some gold panning contests when he was younger. Yes, there are such things. So I love this sector, but what I love most about it is the opportunity to make a lot of money and to make it actually fairly rapidly. And that's what mining stocks can do. They're extremely volatile. Obviously, the goal of buying them is to try to capitalize on that volatility. But like you said, we do have to emphasize that they are speculative in nature. These are not widow and orphan fund types of stocks. They are not heirlooms. You buy on the way up and you sell and you try to get out at the top. So, but as Mike was saying earlier, they're dramatically undervalued despite the big bounce that we've seen. And I can give you some examples if you want, but they're still dramatically undervalued despite that. Whether you compare gold stocks to gold, whether you compare them to the S&P, whether you compare them to where they've been before, whether you inflation adjust their prices, any way you look at it, gold mining stocks, gold and silver mining stocks are still dramatically undervalued relative to history. So, and especially relative to where the price of gold and silver are. So the opportunity is still there. Now they have run up quite a bit though. My net worth was here in January, and then it was here in March, and then now it's back up here. So, and a lot of that has to do with mining stocks. So,
Congratulations.
Well, I mean, a lot of them have doubled and tripled. I have two that have done 5x just since March, the March lows. So I've actually started taking profits on a lot of these just because they've run up so much. So I think that's more of a risk management decision to take profits, and not because I don't think they're not going higher. But I am hoping for a pullback. I hope they pull back a little bit. I hope gold and silver pull back a little bit. They've been quite a run, so I'd like to see them pull back a little bit to try to get in at better prices and that sort of thing. So that's what you want to look for. But the main thing to know about mining stocks is if you believe gold and silver are going higher, regardless of what the economy and the S&P do, if you think gold and silver themselves are going higher, then that's a cue that, that would be a time to be in mining stocks. If you think gold and silver are going to be flat or not going anywhere, then that would not be a time to be in mining stocks. As I said earlier, I think gold and silver are destined for much higher prices. And so I am definitely long mining stocks and think that I'll be making a lot more, quite frankly. And the reason is because the word you mentioned, leverage, they have tremendous leverage to the metals prices themselves. Computer chips don't fluctuate in price that much, right? Selling a computer, Apple is selling a computer, the price of computers don't fluctuate in price that much. But the product that these producers sell, gold and silver, does fluctuate a lot. So, a 10% rise in the gold price might mean 100% rise in their earnings. And that's the kind of leverage you can get with a gold and silver miner if you catch them at the right time. So the leverage can be absolutely tremendous. That's why they can be so volatile. So I think over the next 2 to 3 years, it's going to be a major bull market for not just gold and silver, but the miners as well.
All right. And to your point there about, the leverage when the profitability changes, it's worth noting that with the steep decline in the price of oil, energy costs are a big input for mines, and one of their larger energy costs has gotten reduced a fair amount. So that only helps the profitability.
And not only that, but the currency exchange too, because a lot of them are selling in dollars, right? But their costs are in some other currency, which is lower. So they're getting a double whammy on saving on costs, not just energy costs, but on the currency cost. And so with a higher gold price in US dollars. So their costs are going down and the price of the product they sell is going up. So it's pretty good for them right now.
Yeah, no, that is a great additional tailwind to this industry. All right, so we don't have a ton of time to get into the actual nuts and bolts of mining and investing, but I think that's a great topic for the next time we have you back on. So why don't we just agree right now, Jeff, to have you back on in a couple of weeks, and we'll really just make it all about that. What makes a great mining company? What do you look for as an investor in a company? But real quick, I just want to give folks a very short background. Probably the most common way to invest in precious metal miners, if you are new to the sector, is to invest in one of the mutual funds that owns a basket of these companies. And probably the best known one out there is called GDX. And that fund holds a lot of the majors, what they're referred to. But these are the larger mining companies that have been around for an awfully long time, generally are quite profitable. They're the safer mining companies. And I'm putting safe in air quotes because I want to reiterate that mining is a highly speculative sector. Then you also have funds like GDXJ that invest in the juniors, the majors and the juniors. The juniors are the smaller companies. They're out there. They've either got smaller operations or they might have exploration companies in there, which are companies that are going out and looking for gold, similar as what happens with oil. And some of those companies are going to find, gold ores, and some are going to go bust, right? So that's where your more speculative plays are in the junior funds. Then you can actually buy individual companies. So you could buy a big company like Newmont Mining, or you could buy a, very small first-time explorer company, and there are a bunch out there, and they trade for pennies. But your potential return, your potential for losing a lot of money is a lot higher with those guys. Of course, if you get one of the few that makes it big, you can make a ton of money with a small investment. My point, though, is to say, if you are going to invest in the space at all, I highly recommend you do it working with a financial advisor who understands the space, and I'm going to let Mike talk about that in a few minutes. But particularly if you're going to look at individual companies to invest in, my strong recommendation is you got to do that under the guidance of somebody who spends their career focused on these companies, that's talking to management, that tracks companies, that knows where these plays are, ideally has experience going out there and visiting these companies, boots on the ground, that type of thing. So giving all this background, because Jeff, I know that you, for gold silver, have put together a guide, a free guide, that kind of breaks down for people the landscape of how to invest in mining companies. True, and if so, you okay with you if I give folks that URL?
Oh, absolutely. It's a great beginner's guide for anyone who's thinking about getting into the mining sector. It does not have individual picks in it. That's a little bit different ball game, but it's a great introduction. It shows how they're still undervalued, how to buy them, what to look for. And it goes over all the funds and even gives some performance of the different funds that you can buy for both gold and silver, ETFs and mutual funds. And it shows you how to get a lot more information, such as conferences and things like that. I also do disclose my personal buys and sells on my Twitter account, just because I told people I would. So you can go there if you want to look at what I'm personally doing. But that guide is a great place to start to get a good, fair introduction into how to approach this sector.
Great. So I'll put the URL up here when we edit the video. It's goldsilver.com/miners. So if you go there, you can download that guide for free and read it all for free. And then also, Jeff, if you could just tell us your Twitter handle, and I'll make sure we overlay that as well.
It's at the Gold Advisor. So I can't give personal advice, so that's not the best handle, perhaps, but that's what it is. It's at the. You have to put the in there because somebody else has Gold Advisor, so it's at the Gold Advisor.
Okay, great. All right, so Mike, I'm coming your way here in about 30 seconds. Jeff, thank you so much. This has been great. And I'm already really excited for the next time we have you on and we can roll up our sleeves and just talk about mining company investing and the steps that you will recommend for folks to take as they evaluate a specific company. But I'm going to put you on the hot seat a little bit here before I let you go. Not asking for a prediction, not going to hold you to this, but as you look to gold, silver, and the mining complex as a whole, what type of appreciation do you think is credibly possible? Not saying likely, but credibly possible in the next 1 to 2 years, given the fundamentals of the landscape that you follow?
Uh, well, I don't like making predictions. It depends on how bad things get, quite frankly, because I think there will be fallout from the monetary things that the Fed and other central bankers have been doing. I just would not be surprised at all to see gold in the $3,000 to $5,000 range and silver potentially hitting, three figures. Uh, the miners on top of that would do it, anywhere from 2x to, whatever, 10x of that. So, hey, I could be wrong. Nobody really knows for sure, right? But I'm basing that on what the Fed has done, and that we've seen no real world effects yet of all this currency printing, and the dollar is still relatively strong, right? I don't think that's going to last over the next couple of years, and that's going to bode very well for gold and silver.
Okay. I don't want to put words in your mouth, but safe to conclude here saying that the 1 to 2 forward outlook for gold and silver is better this year than you've seen it at any point in time in the past 8 to 10 years?
Oh, easily, yeah. Yeah, I mean, gold peaked in 2011. The same with silver. They crashed hard in 2013, and ever since then, they've been pretty much dead money almost. Now, they did bottom in 2016. They've been slowly inching up since then. But last year, and especially this year, is when they've really taken off, as evidenced by all those stats I gave you at the beginning, just how high they are right now, trading right now, especially for gold. Yes.
All right, great. Well, Jeff, hey, thank you so much. We talk a lot about gold and the wisdom of owning it at Peak Prosperity. With our YouTube audience, with coronavirus, we've brought a whole bunch of new viewers and audiences into kind of the world of things that we talk about. And so for a lot of those people, I think they haven't really kind of heard the fundamentals before for why it's so important to consider at least holding some gold and silver right now. And I think you've done a great job of explaining that in a really intuitive way. So thank you. All right, Mike, heading over to you. If folks have been watching this and been inspired by Jeff's analysis, and they want to actually consider putting some of this into practice in their own portfolio with their own investment and investment capital, how would they go about doing that?
Are you asking about on their own or with our help, Adam? We'd be happy to help either way. I mean,
yeah. Well, I said earlier, I don't think people, especially people that aren't already well experienced in this space, should be doing it on their own. They should be doing it under the tutelage of somebody, and you're the best people that I know. So let's assume you.
Makes sense. Makes sense. Well, I mentioned earlier that precious metal mining shares have been a core component in our portfolio for some time. In fact, several years now. We've got anywhere between a 10 and 20% exposure to the whole sector. We believe in getting exposure to the whole sector. We're actually in several exchange traded funds, some of which you mentioned earlier. We think it's important to get exposure to the macro move of that market. As Jeff was just talking about earlier, it's probably going to have a very good few years in front of it, and we don't want to miss out on the beta. If you will. You had another guest that I think used that term talking about gold miners. Make sure you get exposure to the beta, which we do through ETFs. Now, if somebody wanted to do that, let's say they were following a newsletter, maybe some publication that Jeff is putting out there, or maybe some of his own picks on Twitter, or maybe some of the other newsletters that are out there, and there's many good ones, and they wanted to implement that with some help. We'd be happy to help them. We do that with people. We do it all the time. We can introduce hedging through options, covered call sales, even buying puts on parts of the position. We're pretty prolific users of options in our core portfolio. And our biggest holding is GDX, the large, major miners ETF, and we do have hedges on that. We sell call options on part of the position, not all of it, because we don't want to cap the price appreciation. And when you sell a call option against something, you cap the price at which you can sell it at. So we just do that on a piece of it, and we use the money that we get from that to buy put options on a pretty good chunk of the portfolio. That helped us in March when we had a pretty swift downturn. But we're big believers. We understand a lot about the market, probably not as much as Jeff and the folks he works with do, and we focus more on the industry instead of the single stock specific focus, but yeah, anyone that wants to implement would be happy to talk to them and help them work through that.
Great. All right. So given that it's so late in the video here, I tend to want to keep these things under 40 minutes, and I seem to fail every week here. And I know you guys are very busy. Mike, anything else about the markets or investing in gold, silver, and the miners that you think is worth letting folks know before we hop off here?
When we first talk to potential new clients or even people that just want to talk, the first thing we're often doing is asking them what their equity exposure is. And, the first most important thing is to reduce equity exposure. Get down to below, 1/3 equities, 30% or less. And then we're asking about different things. We're always asking whether they have a core holding in bullion, gold and silver. And, anywhere between 5 and 20% for most people is what we're recommending. That's a wide range, I understand, but we recommend that they buy this bullion and ideally hold it close to them, at a place they can get their hands on it. Secondarily, if they're not comfortable with that, there's plenty of depository options. But we think it makes sense to reduce stock market exposure. Again, New Harbor is 0% exposed. Build some bullion, maybe 5 to 20%, ideally where you can get your hands on it. In the actual investment accounts, we think 10 to 15% or even a little more makes sense exposure to mining shares. Other than that, we're very heavy in cash. We're more than 2/3 in T-bills still. We're still expecting that next wave down in this market, the one that's actually the fastest moving and most dangerous. Interestingly, as the weeks go by, less and less people are talking about that possibility, which actually ironically makes it more likely to happen sooner. The timing is impossible. We continue to wait for that to happen, and that's what we'll keep doing. So, no, I don't have anything else to add besides that.
No, that was great. All right, and Jeff, so many things to follow up with you on, but I think when we have you on next too, because you're so close to both companies, we should just give folks a little bit of the overview of both goldsilver.com and the Hard Assets Alliance, because it dovetails with what Mike just said, which is somebody is watching this and they've said, okay, look, you've convinced me. I think I actually want to own some gold and silver directly. What are good places to go out and actually get that? And both companies have their own unique strengths, but gold, silver in a nutshell, it's a great place to buy gold and silver online if you want it shipped to you, if you actually want to get your hands on the physical bullion itself. If you want to have that bullion stored for you, which a lot of people do either because they don't want to risk losing it or getting it stolen at their house, or it's just so much that after a while, after a while, silver becomes, really heavy to carry around. So they have, Brinks vaults and high security locations like that where the silver and gold can be stored in your name. So anyways, we can get into the details of kind of the benefits of those companies. And I know HAA just announced this. I'm not sure about gold, silver, but I know HAA just announced an easy way to buy bullion inside your retirement plan. Right? So if you've got money in an IRA, you actually can now buy bullion and have it held in your name through the HAA, through your IRA, which I think for a lot of people is kind of a game changer for capital that they might have felt was sort of stranded from those types of investments. So, all right, with that said, guys, great week. Thanks so much for all your time. Jeff, again, I've mentioned, I kind of already pre-committed you to at least, coming back again in a few weeks. Is that okay with you?
Absolutely. I would love it. It's my favorite subject.
All right, great. And if you are interested in talking to the folks at New Harbor, stick around because at the end of the video, we give you a bit of information on how to do that. Mike, as normal, as you're talking, I'll put up the greylockpeak.com URL so folks know how to submit a request to you guys. In a nutshell, though, Peak Prosperity has worked out, we've had a long-standing relationship with the guys at New Harbor. And if you've got questions about buying gold and silver, if you've got questions just about your portfolio and how it's positioned and what your risks might be to a market downturn, or what New Harbor's thoughts might be on how you might want to restructure it, you can schedule a free consultation with them. It doesn't cost you anything. There's no commitment needed to work with them. It's just something they do for Peak Prosperity audience members, because we've sent so many clients to them in the past that they're happy to do it, and they do it as a public service, and we're incredibly grateful that they do. So with all that said, great seeing you guys this week. Again, Jeff, look forward to having you back in a couple of weeks. Mike, I will see you next week.
Thanks, Adam. See you next week.
Thanks, Adam.
All right. Take care, guys.
Bye, Jeff.
Bye, Mike.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.